Welcome, everyone, to our 2024 Mid-Year Review. As always, my name is Kerry Williams, Portfolio Manager and Director of Research at North Road Investment Council. We are recording this on Thursday, July 25th, and I am joined by my colleague and fellow Portfolio Manager, Marshall McAllister. Marshall, how are you today?
I'm well, thank you, Kerry. Thanks for the introduction. We're having an interesting day here. It's a sad day in Alberta. We've got lots of smoke in the air, and we're just now getting some challenging information about our beloved town of Jasper, and seeing some of the sites of a big fire that came through there last night and this morning. It's really challenging. Our thoughts are going out to people that are from Jasper and all the first responders that are working in that area.
For sure. It seems like wildfires are a part of our life every summer now. And I know our colleagues and clients in Vancouver and BC are feeling the same way at this point, unfortunately. So we're going to talk about markets. Yeah, we're going to talk about markets today and what's been happening. But as always, investing is a means to an end, right? And we're keeping the people that are close to us and some of those other things that are important in our mind, even while we're talking about investments. All right, Marshall, I'm going to share a visual screen here for everyone. If you're listening to this, this is a visual presentation today. We're going to show lots of charts as to what's happened over the last half a year. We're going to compare that to the last couple of years because there's been a lot happening across markets with higher inflation and higher interest rates. So we're going to show how the last 6 months as compared to the last couple of years. We're going to talk a little bit about equity markets, bond markets. We're going to talk a few minutes on how our viewpoint on bonds is changing and some recommendations and some changes we're going to be making and transitioning through on the bond side. We'll update everyone on inflation, and we'll wrap up a little bit with talking about U.S. elections because it's impossible to escape that news right now, isn't it, Marshall?
Yeah, absolutely.
Okay, let's get going. Capital gains tax changes, Marshall. This seems like it was a lifetime ago already, even though it was only a few weeks ago with everything happening in the U.S. election news. Fill the folks in on what's been keeping you busy with capital gains tax changes.
As of June the 25th, a new tax regime is coming into force where capital gains inclusion rate for corporations and trusts are moving from 50% to 66.6%. So as investments and properties are sold at gains, a higher level of income needs to be added into the capital gains calculation. This also impacts personal investors. So capital gains greater than $250,000 per year are going to have the portion greater than 250 taxed at the 66% inclusion rate over the 50%. So for you and I, Kerry, this is going to change some of the planning and income planning that we've done and are going to be doing into the future. Challenging news, but we're just going to have to work with the information that we have and do our best as we manage these tax plans and investment plans.
Yeah, I think for most individual clients, Marshall, this probably will not have a major impact, especially for liquid investments. We'll be able to manage gains as best as we can to keep under that 250,000 limit. Obviously, a significant impact for corporations and trusts. One of the areas I think that individuals need to be aware of is this idea of the second home or the cottage. You know, if we've got 30, 40, 50 years of gains in a cottage and that suddenly gets sold, that may bump folks up above that 250,000 mark, right?
That's right. Yeah. Primary residence won't apply. But yeah, second properties definitely.
For sure. All right, moving on. Let's talk about markets. So let's touch on, I'm going to take a second here, Marshall, and just bring out my red highlighting dot so that I can show folks a couple of things to look at within charts and walk through what this is going to look like. Right now, what we've got on screen is Canada versus the US versus the globe. So we're looking at, on the left side, January 2022 to June 2024 dates. So the last couple of years, let's call it. That's the chart, the line chart that we're looking at. So we can see January 2022 all the way to June 30th of 2024. On the right side, we're showing just 2024 year-to-date returns. So we can see the comparison on one chart here between what's happened in Canada versus the US versus the globe. So we actually saw that through 2022 and 2023, when interest rates and inflation were really part of the story, the Canadian composite index did okay in the TSX in comparison to the US and the rest of the world. Since things have turned, we've really seen the U.S. rocket up in the last kind of half a year and a little bit more than that.
Yeah, that's right.
Yeah, and we see that in the 2024 year-to-date numbers. The Russell 3000 is the index we've chosen here for the U.S., up 17%, a little over 17% in the first 6 months versus 6% for the Toronto Stock Exchange and a little over 9, almost 9.5% for the rest of the world. Okay. Anything you want to add there, Marshall?
No, I think that's good.
Okay. Let me see if I can get us to the next screen. There we go. Large versus small. So our clients, I think, are all aware that we're really focusing in on making sure we're diversified across size of company. And very interesting story happening towards October 2023, as we saw markets really start to turn away from some of the fear and concern in 2022 and early 2023. And we see this really big divergence where, again, U.S. large companies in this case really taking the bull by the horns, to use the bull metaphor, and really rocketing. So up 20% year to date in large U.S. companies, and you can see that in the chart. It goes even further back to October 2023, and significantly higher even than the rest of the world.
Yeah, double the returns of large companies ex-United States. Significant.
Yeah, and we can see small companies around the world have trailed on that end. And so we're going to talk quite a bit about large versus small today. Anything you want to add there, Marshall?
Okay.
All right, let's keep going. Okay, this to me is probably the most interesting story of what's happened in the last little while. So U.S. large growth companies, think high price companies, very exciting companies, typically tech, versus U.S. small value companies. So think smaller companies, less exciting, lower prices to their stock versus some form of accounting metric. We can see that growth through 2022, 2023, when there was lots of concerns around inflation and rising rates, fell quite hard through that period. And then since kind of early 2023, just this incredible line up and to the right for large growth companies, up 27.5% in 2024 year to date, versus small caps, which have been more steady, but are actually in the smallest group of the S&P, the small cap 600 value, were negative to slightly to the end of June.
Yeah, so positive over the entire time value for going back to 22. Just over 2% for the small value, and the compound return for the S&P 500 growth index at 8.5%. So 4 times the return over that 22 to June of 2024.
So one of the questions I think, Marshall, that is pretty natural to consider then is why invest in small caps? Beyond even just the last 2 and a bit years, really large U.S. companies have been the place to be for, let's call it a decade, as the large U.S. tech companies in particular have been incredibly profitable. Prices have fallen in line with that. And it's been a really good time to be a tech investor outside of some significant volatility. And so one of the things that I thought was valuable was this chart comes out of a group called Ritholtz in the U.S. that you and I are fans of the content they provide. And what we're seeing here is, again, large versus small companies, the S&P 600 in small, S&P 500 in large, but cherry-picked around certain dates going back to the 90s to show how there can be long cycles of outreturn, not just by large companies, but also by small companies. So on the left, we've got 1995 to 2000, where, again, large companies, S&P 500 almost doubled small companies. We've got 2001 to 2013, where small dramatically outperformed large. And then we've got the last decade again, where large has outperformed small. Not predictive that we're going to see this reversal again, but just an indicator of why we hold small companies in addition to large.
Yeah.
As you and I often say, we don't dislike either of these. In fact, we like them both.
Mhm. Yeah, our clients are not holding 100% small caps in their equity allocations. It's closer to a number like 20%. Um, but still, we need to understand why we have exposure to small companies, and we can look at returns going back to the 20s in the United States and maybe not so far in Canada. We can see there has been a positive premium for owning smaller companies. So for us, the evidence is compelling to continue to own smaller companies, and we're hopeful that we'll be able to pick up premiums in that space for decades to come.
All right. And on that note, we showed to the end of June. The last few weeks have had a really fascinating situation happen. So, what we've got here on the screen then is in the line chart, June 28th, so the last trading day in June of this year, to July 23rd, just a couple days ago. What's been happening? So in blue, we've got the S&P 100, the 100 largest companies in the U.S., what are often called mega caps, mega large companies, and just dramatic outperformance in the first few days, in line with what we've seen since October of 2023. And again, underperformance in the small cap, the 600 S&P small cap 600 value. But right around the 10th of July, we see this huge divergence with what I would say is almost a historical outperformance by small cap, where we had this massive jump in just a few days, and we've had this reversal in small cap versus
Yeah,
large.
yeah, it's been a fun month.
Yeah. For us, where
In
we've
that
got this
regard,
focus on
yeah,
small,
it's
this
fun
is
to
way
see.
more fun. Yeah,
Yeah,
yeah. So is this a predictor of the future? No, but there's a reason why there's been a catalyst towards small, Marshall. And I think, there's probably multiple catalysts, but one of the big things that happened around this time frame of this shift was the Federal Reserve in the U.S. came out and said inflation is slowing, and they feel good about that, and there may be rate cuts coming. And smaller companies often have higher debts,
yeah.
especially than the very large cash-rich tech companies in the U.S. And so we've got this real interest in small companies from investors again. Anything you want to add?
No, that's good.
All right, let's turn our attention to bonds and fixed income. Do you want to take this one, Marshall, or you want me to?
So positive returns in the bond market for the first 6 months of 2024. So one of the investments that we use is a dimensional strategy that holds 5-year bonds around the world. So we're seeing close to 2.4% positive returns. The overall index, or the whole universe, which holds short, medium, and longer term bonds, actually showed a negative return for the period. We are, I guess we're delighted to see that our exposure in the bond area has been accretive to returns for this period. Interest rates are starting to come down. We just had an announcement from Tiff Macklem, the Bank of Canada governor, where interest rates fell by 50 basis points this week. So we're seeing the bank rate move from 4.25 to 3.75. And that has a big impact on bonds. So as we see bond prices for the next month, returns could even be better going out into longer periods.
Yeah, it's nice to see that happen now that we're on the other side. Obviously, Marshall, as many of our clients saw, and that we've talked a lot about, 2022, 2023 was a tough time to be a bond investor, especially long-term bond investor. You and I and our clients have held short-term bonds for a really long time, as interest rates were so low prior to 2022, recognizing that as interest rates go up, bond prices go down. So there's risk in bonds when interest rates get really low. And that paid off for us in 2022 as rates rose. We didn't feel quite as much pain in our portfolio. But for folks out in the world holding long-term bonds, that sort of minus 25% in your quote unquote safe income asset is pretty painful.
Yeah, and that in connection to that, we're looking at our portfolios here at North Road Investment Council, and we're seeing now that the carry or the kind of go forward return that we're getting from our more conservative core fixed income position is reasonably attractive. And in the last number of years, we had been moving into more higher risk credit and other areas of the bond market to try to pick up some extra return, just because the carry rate on our bond portfolio is just so low. I mean, it's getting close to 0 or 1%. So now that we're in a new regime, we are going to be moving away from some of that riskier bond exposure, and we're going to bring it more into our core bond exposure. And through time, that will allow us to kind of move the risk budget over to the equity and the alternative side. And we believe that that makes for a better portfolio experience for our clients.
Yeah. So to really put this, bring this to a head, Marshall, as clients look at their portfolios, the line that shows up as growth fixed income or fixed income growth,
yeah,
clients are going to start to see that trend lower as a percentage of the portfolio as we start to get them out of those more riskier, more aggressive fixed income options and more into the core and more conservative side, correct?
That's correct.
All right. Let's keep moving on here. REITs. I have had a lot of conversations with clients about REITs, Marshall. I'm sure you have as well. I think many folks would be surprised prior to 2022 to see real estate stocks as REITs fall 30% in a little over a year and a half in Canada, which is what happened through 2022, 2023. How about you? How have your conversations been going around REITs?
Yeah, it's disappointing to see the prices. I mean, going back to 22, this is like a 9%, 9.4% negative compound return on the Canadian index. Years before that, it was some of our best returns.
Yes.
And so we wrote it up, and we've written it down. We don't have a massive exposure to REITs in our portfolio, but there are exposures, and disappointing to see. We're not going to stop owning REITs. We're rebalancing. We're owning them. We believe that returns will come to us as investors in this space, and we're not going to abandon this asset class.
And they are a unique asset class as a result of the way real estate income trusts are structured, right, Marshall, with a certain amount of backing by assets and some leverage. They do seem to have this sort of position almost in between fixed income and equity as a result of that. So a nice diversifier. Diversifying always means having to say you're sorry for something if you own everything,
you're
right?
Not going to love everything at every interval, right?
That's right. So this is one of those areas that has been challenging. But I think one of the interesting parts about this chart here that we can see is this massive rebound towards the end of 2023 in prices. And as some of the concern around interest rates and inflation started to decrease, we start to see some of the hope towards REITs from investors get a little bit better, a little bit higher.
That's good.
Anything you want to add there, Marshall? Okay. Momentum versus value. So getting back to talking about factors, these characteristics within markets that provide us with premiums and returns. Momentum versus value is one of the key conversations we have. And over time, we're moving clients towards investments where they can hold on to both of these different strategies because they're not perfectly correlated. We like to hold them both. Yeah. And we can see that they do move differently. So in this chart, again, going back to 2022 on the line chart and year to date towards the right in percentages, we can see that at least this year, AQR US Large Cap Momentum Index is showing us what we've seen the whole way along, which is that the large cap companies in the US have been really powerful, up 25, almost 25.5%, more than international. Although, Marshall, I would never be concerned with an international momentum index providing me almost 18% over 6 months. That's pretty nice, even though it's a little lower than the US, right?
That's right.
Yeah. And we can see below that this year value up to the end of June has trailed momentum on that end. Although, looking at the chart on the left, we can see that value was pretty nice to hold through 2022 and early 2023 when value fell quite a bit less than growth companies through that period. All right. One other part of the story, Marshall, is that in addition to the large cap companies being the big performer over the last little while in the US, we can even narrow that down even further. And the vast majority of returns are coming from a small group of tech companies, often referred in the news as the Magnificent Seven. And this chart, I think, just shows how much of that is playing into the market, especially NVIDIA. So probably most folks have heard about NVIDIA by this point, a chip maker focused a lot on the AI, artificial intelligence chips, and the infrastructure underlying a lot of what's happening in artificial intelligence for other companies. And as a result, the stock price has really boomed, as has their profits from that perspective. That being said, as happens with growth companies, when they do boom, valuations are very, very high at this point. Anything you want to add there, Marshall?
Yeah, these are businesses that are in the portfolio, but at a very, very small weight in comparison to market cap weights. Just because our general strategy on the value side of our portfolio is has expectations for lower long-term returns. Not zero returns, but just lower.
All right. One of the interesting things I found that's similar, Marshall, this chart, there's lots here, but to narrow things down, what we're really trying to look at here is what percentage of the S&P 500, so the 500 largest companies in the US, what percentage of those companies is outperforming the total index, so the average of the full 500. And what this chart is showing is that so far in 2024, that percentage on the far right side where the black arrow is and the red dot is the lowest it's been since the 1970s. So showing here that the number of stocks providing the returns is very, very small. Or at least the out return, I should say, outperformance is very, very small compared to history.
Yeah, that really ties into articles that we've read and research around like the dispersion of returns and how there can be a very, very small number of companies in a marketplace that drive the returns for the entire industry or the entire geography. And if you were to pick companies as your investment strategy, that could increase your chances of not capturing those fantastic performers. And I continue to be convinced that owning thousands of companies in a variety of geographies allows us to pick up those good news stories and to benefit from it. And it eliminates or reduces the risk of us kind of missing that the kind of rocket ship that can happen with a few of these companies.
Yeah, for sure. All right. So that's markets up to this point. Let's talk about a few of the questions we've been getting from folks and some other topics. So some additional insights. Inflation has been top of mind for, I think, just about everyone over the last couple of years. We wanted to give an update on inflation. This shows Canadian inflation, CPI index in green and the US in blue. I think an important note here, Marshall, is we can't really compare the two apples to apples because they do measure things slightly differently. But we can see that in general, while inflation is bumpy, it seems to be leveling out, and the most recent data does seem to be showing that it is starting to come down, at least in its ongoing increases. And so, as a result, we're seeing the Bank of Canada cut rates, and the U.S. is talking about cutting rates soon as well.
Yeah, exactly. This is good news for Canada.
For sure,
inflation was a concern.
Yeah,
quarters ago. So it's great to see this.
Yeah. One of the things that came out of the conversation around inflation and the research that you and I and our team have done was looking historically at how often do stocks and bonds move down, so decrease in value at the same time historically. And that tends to be when inflation surprises happen. And so one of the things that we made changes to in the last kind of year and a bit with North Road is adding more alternatives and asset classes that are a little different from stocks and bonds. And so wanted to give an update on how that's been so far. And we can see for folks where it's been appropriate to own alternatives, there are some unique risks in owning alternatives, in particular liquidity risk. This is what things have looked like in the three areas we've added year to date. So music royalties here first, the AQR multi-strategy fund here in the middle, and then Manulife's real asset investment fund, which is focused on private real estate infrastructure and farmland and other real assets.
Yeah. So at a high level, we're very pleased with the first two categories. The music royalties have met our expectations. The Apex strategy from AQR, that's a long-term investment strategy, and it's going to have some variability that we know is going to come out. And it's nice to see a positive return at the outset. The Manulife real asset strategy, I think the real estate exposure inside of this private asset pool is driving most of the story, where the returns aren't as attractive as other categories in the portfolio. But that's okay. Maybe we'll just transition over to the farmland that we've had. The majority of our clients have private farmland as an exposure in the real assets side of their portfolio. And while we don't have returns for 2024, we do have returns going back annually to 21 through to 2023. And we've been very pleased to see the investor net return 8.5% for 2023. We are going to be doing some further education and presentations on Area 1, and we're going to be hosting an event in Edmonton and an event in Calgary. So the event in Edmonton is going to be on the 10th of September, and the Calgary event is going to be September the 11th. We're going to be inviting clients to come and learn more about why we own this in the portfolio, and just to learn some more details about the farms that we do own and potentially the farms that we could be owning in the next fund that's going to be launching here later this year and into 2025. Did I miss anything, Carrie, on that front?
I don't think so. I think I would touch on some folks who may watch this may think, oh, I don't recall hearing about this. We are recommending alternatives to folks where it fits. We're usually chatting, I think, with everyone and making the transition slowly over time where it makes sense. But often we do have clients who alternatives don't make sense for them based on liquidity and other goals. So the beautiful thing about being independent is we can do custom portfolios and make choices that are right for each individual client and family. So watch your email for some information on some events coming up and some more information on alternatives, and we'll be helping you figure out if it's the right fit for you. Let's talk elections, Marshall, because this, I think, is on everybody's mind. What a wild, unbelievable month we've had in U.S. politics. Yeah. In a lot of ways, disconcerting and a little bit sad, to be a bit frank, around the assassination attempt. But happy to see that an assassination attempt was not successful. No matter where you lie in the political spectrum, that's not something that we want to see in any of our politics in a democracy. But turning it to markets, I thought in conversations with you, Marshall, it was valuable for us to talk to clients about what does it mean when a new president comes into power, for lack of a better term, in the United States. Marshall, what do you want to touch on in this chart?
Well, I think Dimensional Fund Advisor has done a really good job at the kind of the concept behind this chart, just highlighting the U.S. returns of equity markets in connection to who's in the White House. One might naively think that a Republican president, being more focused on being business friendly and lower taxes, might have more influence over markets and cause markets to rally more than a Democratic president. And that's just not coming out in the data here. There's no pattern between Democratic and Republican. So for us, we're going to own markets regardless of who's in the White House, and that also translates to Canadian markets and non-North American markets as well.
Yeah, I think this is a really powerful chart, Marshall. I hope it helps ease some people's potential concerns around elections. Politics can be very important in individual lives, but when it comes from the perspective of markets, there is a lot happening in economies and in markets. They're very complex, and who is politically in power is just one of the aspects. And over time, we need to be investors that look for markets to do what they do, which is reward good companies that create good value for their customers.
Yeah, agreed.
That's it, Marshall. That's our disclaimer.
Very
What
good.
do we miss? Anything you want to add on? Any updates on
we
North
kept
Road?
it under an hour, so good job, Carrie. No, I think that's a good wrap up for this first 6 months, and looking forward to connecting with clients and continuing our reviews and our updates on our policy statements, and lots of work ahead of us in the next couple of quarters.
Agreed. I'm really looking forward to catching up with folks now that they're back from being down south for many of our clients. We're going to see lots of folks at Thanksgiving when we have folks into the office for the open house, and you're going to hear about a few events coming up in September. So please watch your email. If you have any questions or concerns, reach out to us anytime. We're happy to chat, hop on video, hop on the phone, or see you in person. Once again, thanks very much from Carrie and Marshall, and the end of our mid-year review.